This is Retirement Lifestyle Advocates Radio. I'm your host, Dennis Tubbergen. Glad you decided to listen in or watch today, depending on how you are taking in today's program. Hey, joining me in the second segment of today's program is returning guest Dr. Jonathan Newman. Dr. Newman is a commentator at Mises.org. He looks at the economy from what I believe is the correct perspective, the Austrian economic perspective. And I'll be getting Dr. Newman's take on where the economy goes from here and other economic forecasts. And that's coming up in this second segment of today's program. Well, it is no secret to many of you that the silver market absolutely collapsed back on January 30. Now, that decline did not come as a surprise if you have been a viewer or listener to the program. I have suggested that the silver rally had gotten ahead of itself. It was extremely overbought and was due for a correction. That said, however, the one-day literally monster decline in silver prices of more than 30% was reminiscent of the flash crash in stocks back in 1987. Now, since many of you watching or listening today are probably not old enough to remember that, I would encourage you to go back and look at a stock chart. It was a huge day one day price collapse in stocks. So let me just say that a one-day correction of this magnitude is not normal when one studies the price action of financial markets. Now, I read a great article last week written by Matthew Piepenburg, who writes for Von Greyer's Gold. Matthew has just terrific perspective on a lot of different topics. And he offered an explanation for the sudden collapse in prices by what he calls coincidences galore, which means they're really not coincidences. Now, I'd encourage you to read the entire piece for yourself. If you go to retirementlifestyleadvocates.com and create a free login, I have a link to the article in my Portfolio Watch newsletter dated February 23rd. Again, that's at retirementlifestyleadvocates.com. I'd encourage you to go create a free login, click on the link, and read the entire article for yourself. However, let me in this segment give you a summary of what Piepenburg says in his piece. There was literally no change in the supply and demand dynamics in the silver market. Silver prices fell from about $120 an ounce to about $78 an ounce in less than one trading day. That was the largest single-day crash in silver in 44 years. Now, the reality is, and this is fact, this is not fiction, this is not conjecture, this is not speculation, but many big banks were short silver. So the rapidly rising silver price was causing a great deal of financial pain to these banks. Then Piepenburg lists the coincidences. At least one big bank with large silver shorts was able to exit its short position in silver at the very bottom of the price decline on Friday, January 30th, at nearly the perfect time due to these conditions that all emerged simultaneously. The first thing that happened was the London Metals Exchange went completely dark on Friday, January 30. Bloomberg reported that the London Metals Exchange suffered a 1-hour delay to the start of the trading on Friday. And incidentally, when you go to retirementlifestyleadvocates.com, I have independently sourced all these points that Piepenburg made in his piece. HSBC, a bank with large silver short positions, went completely offline on January 30, the same exact day the London Metals Exchange went dark. That same day, January 30, COMEX raised margin requirements for gold and silver futures contracts. When margin requirements are raised, it forces traders using maximum margin to sell their positions to maintain the required amount of equity in their account. And finally, the announcement of the new Fed chair nominee, Kevin Warsh, happened on the same day, but it happened after the Asian metals markets had closed. Now, let me give you some perspective on the margin requirements. COMEX raised margin requirements in 1980 as silver prices rose to nearly $50 an ounce. It caused the prices to decline. They did that again in 2011 as silver prices once again approached this $50 per ounce level. I believe this time around may be different, though. There is increasing demand for the physical metals, as I pointed out in a recent Portfolio Watch newsletter, February 16. Again, you can check that out by logging in to retirementlifestyleadvocates.com. I noted that in the last 18 months, demand for delivery in the futures market has increased about 400%. So it's indisputable that there is increasing demand for the physical metals. And after a period of consolidation, which may require some patience, I expect more upside for precious metals. Also, before I get to the first break, many of you probably saw that when Warren Buffett stepped down as CEO of Berkshire Hathaway at the beginning of this year, he left his successor with more cash than Berkshire Hathaway has ever had. Buffett left his successor $382 billion in cash, again, a record level for Berkshire Hathaway. And Buffett raised that cash on his way out as CEO by selling lots of shares in Amazon, Bank of America, and Apple. He did purchase some Chubb and some Chevron, but the fact that Berkshire owns or holds $382 billion in cash really tells you all you need to know about what Buffett's take is for stocks moving ahead. I'll be back after these words with my special guest, Dr. Jonathan Newman. Don't go away. Dennis Tubbergen here, host of RLA Radio. I'd like to invite you to get my latest special report titled 3 Retirement Mistakes. If you're already retired or you aspire to a comfortable, stress-free retirement, this report will not only outline the 3 most commonly made retirement planning mistakes, but also help you put guardrails in place to avoid them. These 3 retirement mistakes occur because of the macroeconomic cycle that continues to repeat itself. In the report, you'll discover where we are in this macroeconomic cycle and what 3 mistakes you could potentially make as a result. To get your copy of this free report, all you need to do is visit requestyourreport.com. The website again is requestyourreport.com. Just let me know where to mail your complimentary copy of the 3 Retirement Mistakes Report, and I'll be glad to do so. Again, the website, requestyourreport.com. Welcome back to RLA Radio. I'm your host, Dennis Tubbergen. I have the pleasure of chatting once again today with returning guest, Dr. Jonathan Newman. Dr. Jonathan Newman is a fellow at the Mises Institute. He's also a regular commentator at Mises Wire and on Power and Market. You can learn more about the Mises Institute at Mises.org. I should also mention that Dr. Newman is editing a book that'll be released later this year titled Anti-MMT. MMT, as all of our long-term listeners know, stands for Modern Monetary Theory. And Dr. Jonathan Newman, welcome to the program.
Hey, thanks for having me. It's great to be on.
So, Jonathan, let's just start for our listeners that may not know what the Austrian approach to economics is. Can you just give us a little crash course?
Sure. Yeah. So the Austrian economics approach is to start with the individual. So maybe the best way to go about this is to contrast it with what you might see in the mainstream. So if you go to a state university and you take an econ program, the way that you'll think about the economy is with a series of equations. So you've got an equation for the firm. They're just doing a profit maximization problem. You've got consumers who have a utility function, and they're trying to find a tangent line on their indifference curve to find the right, bundle of goods to purchase. In the Austrian school, we don't approach economics that way. We don't use math, and instead, we understand that individuals have subjective preferences. We understand that firms and entrepreneurs are trying to estimate, they're trying to anticipate what consumers want in the future, and so they use market prices to decide what to purchase, and they're forming market prices as well based on their preferences. And so the way that we approach economics is in this way. So it's a very real world, down to earth sort of way of approaching economics, as opposed to all of the cacophony of equations that don't pertain to the real world. Now, what the Austrian school is probably most known for is our very laissez-faire policy prescriptions. So, of course, policy prescriptions aren't a part of economic theory itself, but if you're doing economic theory and it lends itself to a certain set of conclusions, that's where the Austrian econ conclusions tend towards, is that governments mess things up. Governments distort the economy when they impose price controls, taxes, money printing, you name it, or regulation. Then they're messing things up. They're messing things up in the way that market participants would have done. And so the Austrian school is known for being radically laissez-faire. So the government should be hands off and let the market work. Markets work wonderfully. They help us economize resources, and governments just get in the way.
So, Jonathan, you may make the same argument about central banks that are actually government sanctioned, and I won't put words in your mouth, but I'll let you comment. But certainly, unintended consequences seems to be the theme when you start looking at, interventionist type monetary policies. Can you talk a little bit about what your take is? Stephen Moran, who is, I think, President Trump's most recent appointee to the Federal Reserve Board of Governors, said the Fed has its third mandate or three mandates, and I'd always heard two: maximum employment and price stability. But he said now we also need to stabilize the long end of the curve. Isn't that economists speak for we're going to have to print more currency?
Yeah, probably so. What's interesting is that if you go back to the Federal Reserve Act, is when it's describing what the Federal Reserve ought to do, it does list those two things that you mentioned: maximize employment and stabilize prices. But there's a third thing that's mentioned there. But the Fed has adopted the dual mandate. They sort of have set this one aside, and that the third part that's listed in the act is moderate long-term interest rates. So, I mean, one sort of nice way to interpret what Myron is saying is that he's trying to bring in that part of the original impetus of the Federal Reserve, is that we need moderate long-term interest rates. But I think you're exactly right. Even though I'm trying to be charitable there, I think really what's going on is he wants grounds for lowering the interest rate. He wants grounds for easy money, pump up the stock market, do things that, make Trump's presidency look good, so that, business is booming. There's a big boost of spending and employment that's associated with that. Of course, we understand that you can't do that indefinitely, that there's going to be a reckoning. So when you mess with interest rates, especially if you push them artificially low, you create these speculative bubbles. You cause entrepreneurs to pursue longer lines of production or huge production projects like these AI data centers. It seems like that's what's going on here. That you get lots and lots of investment into these things, and then the revenues don't pan out. The cash flows associated with those projects don't seem to pan out, and it was because of the artificially low interest rates to start with. So we're critical of artificially low interest rates. We're critical of expansionary monetary policy. We think that interest rates ought to be left to the market. Let consumers decide how much they want to save and invest. Let businesses decide what is an appropriate interest rate for me to borrow so that I can fund my business. Instead of having the government say interest rates ought to be lower, because that's what causes all of these problems that bubble up to, quite literally sometimes, bubble up to huge financial crises.
You made a comment there, Jonathan, that this trajectory is not sustainable. Those weren't your words, those were mine, but I think that's essentially what you said. And I think it was Ludwig von Mises who said that the end game here is a crack up boom. Correct me if I'm wrong. And what does that look like?
The crack up boom is a term that Mises used to describe a hyperinflation. And I don't think that we're there yet in the US. Definitely not, because in a hyperinflation, you would see astronomical increases in prices. Although we are experiencing and we have experienced price inflation more than we have in decades. It's definitely not at the level that Mises would say we're in a crack up boom right now. Now, what happens in a crack up boom is that there has been so much money printing that people start to lose confidence. They start to, discard and not demand the money that's being printed. So there's a big increase in the supply of the money. At the same time, there's a big decrease in the demand for money. And so what happens is prices just shoot through the roof. And like the most notable examples that we have is the Weimar Republic in Germany between World War I and World War II. But we've also seen it in Zimbabwe in the 2000s, in Venezuela, in Hungary, in various places where the state couldn't finance its own expenditures by borrowing and by taxing, and so it resorted to the printing press, and that led to a crack up boom. The crack up boom is sort of like the last resort of a government that does not want to go through the painful but necessary correction process. So, as I mentioned before, when you use easy money and you push interest rates below what would have prevailed on the market, you get entrepreneurs to start all these projects that won't pan out. Now, one way to, make the numbers play along is to just keep printing money. Like keep doing everything that you can to push interest rates down, keep stimulating spending. And so Mises pointed out that if the government never allows the correction to take place, but instead decides to keep printing money, then you end up with a crack up boom or a hyperinflation. Let's hope that never happens here.
So, what is your forecast, Dr. Newman, moving ahead? What do you see for the U.S. economy based on what you know about government spending and monetary policy moving ahead?
I'm not optimistic. I think I agree with the Fed chair uh, when he says that the federal debt is on an unsustainable path. So government spending is just on this path that it doesn't seem like it can be stopped for political reasons mainly. And that's because the things that would need to decrease to get the financial house in order are things that are sort of like political untouchables. Like you can't touch Social Security, you can't touch defense spending, you can't touch Medicare, Medicaid, you can't touch these huge segments of the federal budget. And what we've noticed that no matter who is president, we've noticed that spending just continues to increase, right? So no matter what, a president or any politician campaigned on, it seems like spending continues to increase. And so we're on this path where the government is going to have to finance larger and larger deficits. And one main reason for that is because the interest payments on the debt that's accumulated is also going to increase. And so because of that, we can expect additional money printing. We can expect maybe higher taxes. Maybe the government will decide to increase taxes in the future. But either one of those, whether it's money printing or lots and lots of borrowing or heavy taxation, none of that looks pretty for the U.S. economy in the long term. Now, I'm not saying that this is all going to come to a head this year. Although it seems like we could end up in a financial crisis or a recession this year. I mean, who knows? A lot of it depends on how governments respond, right? So it's impossible to predict exactly when these things are going to happen. But in terms of like a long run trajectory, I'm not super optimistic. I think we're on a path of increasing government budgets and heavy taxes and or lots of money printing and more price inflation.
Well, I'm chatting today with Dr. Jonathan Newman. He is a fellow at the Mises Institute. You can visit Mises.org to learn more about their work. Jonathan, is it fair to say that if the government does not pull back and allow a reset as far as just cutting back in spending to occur, that we will have to see a crack up boom at some point? I mean, is it really just one or the other?
I mean, that's difficult to say. And the reason why is because a lot of it depends on what other countries do as well. So, like, if you look at the dollar and you compare it to the way other currencies are doing and what other central banks around the world are doing, it could be that there's, inflation across the monetary inflation across the board, which means in terms of just the dollar, it's hard to say whether or not it'll rise or fall. Um, but I do think that as I mentioned before, the long run trajectory is increasing government spending, which means more wasted resources, either economic decline or less growth than we would be capable of, otherwise be capable of. And so I don't want to sound like this, this doomsayer, but I do think you're right that once you're on this sort of path, it's very, very difficult to get off of it. And a lot of times the solutions to get off of it are politically unpopular, which means it's difficult to, vote people in who will do the right thing and rein in government budgets, who will stop the money printing and who will allow the necessary corrections and, the healthy things that we need to happen to allow those to occur.
So, Jonathan, Kevin Warsh is now nominated to be the new chair of the Federal Reserve. When that was announced, metals prices corrected, which I would argue that they were due for a correction anyway.
Yeah.
But part of the reason given by the mainstream press was that he is hawkish on inflation. Do you think he's hawkish on inflation? And if he was, would he have gotten the nomination?
No, I don't think he would have gotten the nomination. Just based on what Trump has said and what he wants to see from the Federal Reserve, I'm doubtful that he would put somebody in place who would go against what Trump wants. I my baseline guess is that we're going to see Bernanke 4.0 basically. So ever since Bernanke changed everything about the way the Fed operates with the bank bailouts and the way that he responded in the financial crisis of 2008. And what we've seen since then is a continuation of those sorts of policies. So Yellen came in after him, and then Powell came in after her, excuse me. And I think what we're going to see is more of the same from Kevin Warsh. So I mean, I would love to be surprised. The I would love to see the people who are saying that Warsh is going to be hawkish, that he's going to try to rein in price inflation. I would love to see them be correct, but I'm not optimistic about that. I think what we're going to see is more of the same.
So when you look at what happened in Argentina with the president there, Javier Milei, he was elected. He said he'd balance the budget in I think it was 3 months or something. I think he balanced it in maybe even less than that. You can correct me if I'm wrong. Um, what would be the economic consequences to the U.S. pursuing a similar policy?
There would be some short-term pain, and there would be some, political fighting over it. It would be difficult for a politician to come in and do that sort of thing, as we've seen with Millet, that he's had some difficulties doing that. But I think that the long run consequences would be great. So if we could stop the money printing, if we could stop the Fed, messing with interest rates, if we could rein in the federal government's budget and, actually see some spending decreases, I don't know when we've ever seen such a thing. But if we could see that sort of thing, then that would be fantastic. Of course, there are some, special interests who would be harmed. There would be some small groups who would be harmed. The people who have grown dependent on the federal government, and I don't just mean, the people who are on welfare, who are receiving, unemployment checks and things like that, but I mean like, government contractors. I mean whole industries that rely on subsidies. So this is not a criticism of government spending that's focused on, like one particular group, but there's a huge segment of the US, both firms and ordinary people who have grown very dependent on a government that spends out the wazoo, that engages in tons and tons of deficit spending. I mean, not to mention the financial sector as well. So those industries, those sorts of people, they would be harmed. But I think in the long run, it would be great for the majority. It'd be great for ordinary citizens to finally have, some semblance of a free market economy where we're the ones who are deciding prices, and we're not, allowing the Fed to manipulate interest rates, and we're not allowing the Fed to give the U.S. government interest-free loans anymore. So if there's some sort of limit, some sort of constraint on what the government and what the Federal Reserve is doing, that would be great in the long run.
So we have time for one more question, Jonathan. When you take a look at the Department of Government Efficiency, which was put in place when President Trump took office, it seems like the whole idea of cutting spending has kind of gone by the wayside, and now the approach seems to be we're going to grow our way out of this problem. Is there a chance?
Oh, yeah, there's a chance. So it could be that there's going to be some AI developments in the future this year or the next 5 years that just totally explode productivity in the same way that we saw in the computer revolution or even the industrial revolution. I mean, that's possible. I've yet to see some promising results from these companies that are releasing AI. I mean, they're doing some spectacular things, but I've yet to see results that point in that direction that we're on the verge of another sort of productivity-based revolution. But it is possible. But the point is that if we do get those productivity gains, that doesn't mean that everything that the government is doing now is okay, because we could have even more growth if we got the government out of the way, right? So if we allow productivity enhancements to occur when these innovations happen in the market, then we get the maximum amount of growth and increased productivity that we can get. So if we have government that's, hampering that, delaying it, or messing things up, then that means we get less growth than we otherwise would have had.
Well, the clock says we have to leave it there. My guest today has been Dr. Jonathan Newman. He is a fellow at the Mises Institute. He is a regular commentator on Mises Wire as well as Power and Market. He is editing a book that will be out later this year called Anti-MMT. I'm going to be sure to add that to my reading list, and you can learn more about the work of Mises at Mises.org. Dr. Jonathan Newman, thank you for joining us today. Love to have you back down the road.
Thank you so much. I'd be happy to come back.
We will return after these words. Dennis Tubbergen here, host of RLA Radio. I'd like to invite you to get my latest special report titled 3 Retirement Mistakes. If you're already retired or you aspire to a comfortable, stress-free retirement, this report will not only outline the 3 most commonly made retirement planning mistakes, but also help you put guardrails in place to avoid them. These 3 retirement mistakes occur because of the macroeconomic cycle that continues to repeat itself. In the report, you'll discover where we are in this macroeconomic cycle and what 3 mistakes you could potentially make as a result. To get your copy of this free report, all you need to do is visit requestyourreport.com. The website again is requestyourreport.com. Just let me know where to mail your complimentary copy of the 3 retirement mistakes report, and I'll be glad to do so. Again, the website, requestyourreport.com. Welcome back to RLA Radio. I'm Dennis Tubbergen, and thanks again to my special guest, Dr. Jonathan Newman, for joining me on today's program. Well, it sure didn't take long for the honeymoon to be over for the newly elected socialist mayor of New York City, Zoran Mamdani. Mr. Mamdani said in his inaugural address that he would, quote, replace the frigidity of rugged individualism with the warmth of collectivism, end quote. I said at the time that quote absolutely made me shudder, but it seems Mr. Mamdani has now done some math, and he's determined he's going to have to raise property taxes to attempt to accomplish his collectivist goals. Surprise, 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 huh? Mamdani announced that the city's operating budget would be $127 billion for fiscal year 2027. That is a $5 billion increase from the prior year. Mamdani has also publicly called for the governor of New York to raise income taxes on the ultra wealthy and give New York City the tax revenues to fund the city's spending. Short of the governor doing that, Mamdani said he'll be forced to raise property taxes on city property owners. Well, Kathy Hochul, the governor of New York, quickly responded to Mamdani's request. She said, "You better cut spending." Reminds me of the Margaret Thatcher quote that is evidently now proven correct, who said, "The trouble with socialism is that sooner or later you run out of other people's money." Governor Ron DeSantis of Florida offered some perspective on the New York City budget. The city of New York has 8 million people and an annual budget of $127 billion. The state of Florida has about triple that many, 23 million people, and an annual budget of $117 billion, less, $10 billion less than the city of New York. As a libertarian capitalist, we can only hope that the New York experiment fails and fails badly for all to see. That's my program for this week. Hope you got something you can use, and I'll be back again next week. Thanks for tuning in.